Ladies and gentlemen, good afternoon and welcome to HDFC Limited Q4 FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note this conference is being recorded. We have with us HDFC's Vice Chairman and CEO, Mr. K.K.M. Mistry, Managing Director, Ms. Renu Sood Karnad, Executive Director, Mr. V.S. Rangan, Member of Executive Management and Chief Investor Relations Officer, Mr. Conrad D'Souza, and Additional Senior General Manager, Anjali Tarapur. I would now like to hand the conference over to Mr. K.K.M. Mistry. Thank you and over to you, sir.
Thank you very much. And good afternoon, everyone. At the outset, I would like to welcome all of you to HDFC's earnings call for the current financial year. The Board of Directors at its meeting held earlier today approved the financial results for the year ended March 31, 2023, which were subjected to an annual audit. Let me start with outlining a few developments in the economy over the last 3 months which have a bearing on the corporation. The Monetary Policy Committee at its meeting held in February 2023 increased the policy repo rate by a further 25 basis points to keep inflation expectations anchored. The aggregate increase in repo rate since May 2022 has been 250 basis points. During the quarter, there was a further uptick in interest rates, consequent to which we have increased deposit rates as well as rates on our loan products. In its April 2023 monetary policy, RBI has paused the rate hikes. RBI will, however, monitor price stability in determining further rate action. The momentum in the economy was strong right through the financial year ending March 2023. This is reflected in a significant pickup in individual loan disbursements and a 17% growth in the individual loan book on an AUM basis. During the year, the loan book crossed rupees 6 lakh crores and the AUM crossed rupees 7 lakh crores. March 2023 witnessed the highest ever monthly individual disbursements in HDFC's history. Asset quality has continued to reflect improvement. Stage 2 and Stage 3 loan assets have reduced from a peak of 9.2% in June 2021 to 6.7% in March 2022 and now further down to 5.0% in March 2023. Over the next few minutes, I will give you a summary of the key highlights of the performance for the year and the quarter ended March 31, 2023. Let me start by summarizing the progress of our business through this period. Our individual loan disbursements for the year ended March 2023 grew by 16% over the previous year. Housing disbursements constituted 93% of individual disbursements in the current year. Growth in home loans was seen in all segments of the market. 94% of new loan applications were received through the digital channel. During the fourth quarter, we sold individual loans aggregating to rupees 9,340 crores. The individual loans sold during the last 12 months amounted to rupees 36,910 crores. These loans were assigned to HDFC Bank pursuant to the mortgage sharing agreement with the bank. Individual loan book growth on an AUM basis was 17%. If the loans amounting to rupees 36,910 crores had not been sold during the preceding 12 months, then the growth in the individual loan book would have been 24%. On a balance sheet basis, our individual loan book increased to rupees 4,99,496 crores. In addition to this, the individual loans sold by the corporation and outstanding as of March 31st, 2023 amounted to rupees 1,02,071 crores. HDFC continues to service these loans. Individual loans outstanding on an AUM basis amounted to rupees 6,01,567 crores, a growth of 17% over the previous year. As at March 31st, 2023, our non-individual loan book on an AUM basis was 1,22,421 crores. As mentioned in an earlier calls, construction finance loans, unlike lease rental discounting loans, have a longer disbursement period as they are disbursed based on progress of construction and after the developer has brought in his equity. Further, over the last few quarters, we have seen some scheduled repayment of earlier facilities and resolution of some stressed assets. We have also on maturity run down exposures in the loan book to ensure compliance with HDFC Bank's norms in view of the impending merger. Such loans aggregated to around rupees 18,000 crores. The total assets under management as of March 31st, 2023 amounted to rupees 7,23,988 crores as compared to rupees 6,53,902 crores in the previous year, a growth of 11%. If no loans had been sold during the preceding 12 months, then the growth in the total loan book would have been 16%. Prepayment on retail loans amounted to 11.3% of the opening loan book. The average size of individual loans for the year ended March 31st, 2023 stood at rupees 36.2 lakhs as compared to rupees 33.1 lakh in FY22. The contribution in value terms from customers with an annual family income of rupees 18 lakhs or more has increased during the year to 53% from 45% during the corresponding period in the previous year. During the year ended March 31, 2023, 23% of home loans approved in terms of number of customers and 9% in value terms were to customers from the economically weaker section and the lower income group. The average home loan to customers in the economically weaker section amounted to rupees 10.7 lakhs and to customers in the lower income group segment amounted to rupees 19.4 lakhs. If we break up the loan book outstanding as of March 31st, 2023 on an AUM basis into different categories, then individual loans constituted 83% of the total loan book as compared to 79% in the previous year. Construction finance constituted 7% of the total loan book. Lease rental discounting loans constituted 9% of the total loan book, while corporate loans constituted 4%. If we were to look at the incremental loan book growth, then for the year ended March 31st, 2023, the entire growth is from individual loans. 98% of the loans were sourced through distribution channels. However, this is largely through HDFC Sales and HDFC Bank. HDFC Sales accounted for 51% of the loans sourced, while HDFC Bank accounted for 31%. Third-party DSAs accounted for 16%. Thus, 84% of HDFC's individual business was sourced directly or through our associates. The Emergency Credit Line Guarantee Scheme was extended to mitigate the economic distress caused by the COVID pandemic. Under ECLGS 1, 2, and the corporation has disbursed an aggregate amount of rupees 1,883 crores till March 2023, which amounted to 0.3% of the loan book. Amounts disbursed under this facility are guaranteed by the central government. The Reserve Bank of India permitted a one-time restructuring of loans under its resolution for COVID-19 related stress. As at March 31st, 2023, the outstanding loans under OTR 1 and OTR 2 amounted to rupees 3,889 crores, which is equivalent to 0.6% of the loan book as compared to a peak of 1.4% in September of the previous year. 98% of the OTR loans are in the individual loan category. The average collection efficiency for individual loans on a cumulative basis, this is not for the month, this is for the full year, over the last full year is over 99%. The corporation has continued to report NPAs in accordance with the revised RBI circular of November 12, 2021. December 2021 was the first quarter when we were required to report NPAs under the new norms brought in by RBI. Since then, we have re-engineered our recovery mechanisms and processes, and I'm happy to report that as of March 31st, 2023, gross non-performing individual loans calculated under the new norms stood at 0.75%, down from 0.99% in March 2022, and a peak of 1.44% in December 2021. So effectively, the decline has been from 1.44% to 0.75%. Similarly, gross non-performing non-individual loans stood at 2.9%, down from 4.76% in March 22. As per the new regulatory norms, the gross non-performing loans as at March 31st, 2023 stood at rupees 7,246 crores. This is equivalent to 1.18% of the loan portfolio, which is down from 1.91% in March 22 and a peak of 2.32% in December 2021. So effectively, over this period of time from December 21 to March 22, to March 23, we've seen a decline from 2.32% to 1.18%. The improvement in credit quality is also reflected in the credit costs, which I will cover later. As at March 31st, 2023, the corporation carried a provision for loans of rupees 12,145 crores. Under Ind AS accounting, both asset classification and provisioning have moved from the incurred loss model to the expected credit loss model for providing for future credit losses. Based on the model, the total EAD, that's the exposure at default, of 6,19,798 crores is broken up as under Stage 1 constitutes 95% of the EAD, Stage 2 is 3.6%, and Stage 3 1.4%. We have seen a 4.2 percentage point reduction in the aggregate of Stage 2 and Stage 3 assets from the peak of 9.2% in June 2021 to 5.0% of the exposure at default over the last 7 quarters. In fact, in the current financial year itself, we have seen a 170 basis points reduction in the aggregate of Stage 2 and Stage 3 assets from 6.7% in March 2022 to 5.0% in March 2023. During the quarter, we have charged a profit and loss account with a sum of rupees 438 crores towards provisioning. The aggregate charge to the profit and loss account for the year is rupees 1,795 crores. The ECL to EAD coverage ratio for Stage 2 assets is 27% and for Stage 3 is 53%. The provisions carried as a percentage of the EAD amounted to 1.96%. As a result of the improvement in asset quality over the last 8 quarters, annualized credit costs for quarter 4 was 25 basis points. Credit costs for the year is 27 basis points compared to 33 basis points in the previous year. We have stated in our earlier earnings calls that as asset quality related issues get resolved, we should over a period of time be able to normalize the credit costs to pre-COVID levels on a sustainable basis. This in turn will have a positive impact on the return on equity. We continue to hold all our investments in HDFC Bank, HDFC Life, HDFC Asset Management, and all our other subsidiaries and associate companies at the original cost of acquisition, which is the price we have paid while making those investments. These investments are not accounted for on a fair value basis. If we were to mark to market the listed investments as of March 31, 2023, the unrealized gain, which is the difference between the market price as on March 31, 2023 and the carrying cost, would be rupees 2,41,392 crores. This unrecognized gain is not part of our net worth, nor has it been considered in our capital adequacy calculations. Our capital adequacy ratio on March 31st, 2023 stood at 24.3%, of which Tier 1 capital is 23.8% and Tier 2 capital is 0.5%. The capital adequacy is well above the regulatory requirement. Risk-weighted assets stand at rupees 4,75,567 crores. At this stage, and as we've done it in the past earnings call, it is important to talk about the return on equity. Under the Ind AS accounting norms, net worth includes certain items which do not form part of Tier 1 capital under the prudential regulations. These include Ind AS transition reserve, deferred tax liability on special reserve, fair value gains on investments through OCI, investments in subsidiaries and associates in excess of 10% of net income, and securitization gains recognized upfront in accordance with Ind AS requirement. These items aggregate to rupees 20,725 crores. Hence, Tier 1 capital is rupees 1,13,260 crores as against a reported net worth in March 2023 of rupees 1,33,985 crores. A more appropriate way of calculating the ROE would therefore be on regulatory Tier 1 capital as against the conventional method of computing it on total net worth. The return on equity based on Tier 1 capital for the year ended March 31, 2023 is 16%. As of date, 3,600 warrants were converted into 3,600 shares of the corporation at a price of rupees 2,165 per share. The last date for conversion of warrants is August 10, 2023. As at March 31, 2023, the corporation's total borrowings amounted to rupees 5,68,222 crores. Term loans, including the external commercial borrowings of $1.5 billion equivalent, drawn in the current year, and refinanced from the National Housing Bank, accounted for 28% of the borrowings. Market borrowings, that is NCDs and commercial paper, accounted for 45% of the borrowings. Deposits as at the year end amounted to rupees 1,52,111 crores and constitute 27% of the borrowings. It is very important to mention here that whilst the deposit level has remained steady, retail deposits now constitute 73% of deposits as compared to 62% in March 2022. We continue to encourage retail deposits, which constitute 16% of the incremental borrowings during the year. With the introduction of the liquidity coverage ratio in December 2021, the corporation is required to maintain liquidity in high-quality liquid assets. The corporation's HQLA, which is high-quality liquid assets, is largely government securities. The government securities holding as of March 31, 2023 is around rupees 63,000 crores. The average LCR for the last quarter was 128%, significantly higher than the regulatory requirement. I will now move to the profit and loss account. The year has seen a volatile interest rate environment, and therefore some of the numbers of the current year are not strictly comparable with the previous year. There are three factors which have affected the profits of the current year. These are: 1, the impact on net interest income due to the transmission gap between increase in funding costs and increase in lending rates. 2, due to volatile equity markets, we had a significantly lower gain on fair value of investments through the profit and loss account as compared to the previous year. Fair value gains for the current year was lower at rupees 362 crores compared to rupees 938 crores in the previous year. Thirdly, the expense ratios are higher as we incurred expenses upfront on staffing, IT, and branching to meet the increase in demand for housing loans as well as some merger-related costs. There was also an increase in legal expenses due to an increase in business as well as resolution of some of these stress tests. Needless to add, whilst these expenses have been incurred upfront, the benefit of the expenses incurred will accrue over the coming periods. Let me first of all speak of the issues which have had an impact on the net interest income. In the current year, we have had rate actions which have had an immediate impact on borrowing costs, which in turn have not been simultaneous with the transmission of rates on the asset side. This we had mentioned in the previous earnings calls also. This has had a short-term impact on net interest income. We, however, overcame this by passing on the rate hikes so as to maintain net interest margins and spreads. Secondly, during the financial year, RBI increased the repo rate 6 times, in all aggregating to 250 basis points. In the run-up to the expectation of the rate hikes, market rates and swap rates increased, and this had an immediate impact on our borrowing costs, while our lending rates increased only after an increase in policy rates. Thus, whilst we had an almost immediate impact on borrowing costs, the lending portfolio repriced over a quarter. This transmission lag has had a slight short-term impact on the NII growth for the year. Lastly, the proportion of the retail loan book has increased to 83% over the last few quarters. Return on equity on both the retail and the non-individual business is more or less the same. However, the spreads on the non-individual loans are higher due to 1, higher capital allocation, and 2, higher credit costs. Net interest income purely on the basis of interest, without taking cognizance of the profit on sale of loans during the quarter, stood at 5,321 crores compared to rupees 4,601 crores in the corresponding quarter of the previous year, a growth of 16%. For the year ended March 31st, 2023, the net interest income amounted to rupees 19,248 crores compared to rupees 17,119 crores in the previous year. If we adjust for the one-time impact of the transmission lag in passing on the rate hikes to the customer, as well as the impact of the swap benefits in the previous year, the NII growth for the year would have been 17%. It is important to note that credit costs are lower as a result of improved asset quality, consequent to a larger proportion of individual loans. As we mentioned several times in the past, we've always targeted a net interest margin of between 3.3 and 3.5%. The net interest margin for the year ended March 31st, 2023 stood at 3.6%. This is an improvement over the year and reflects on our ability to manage the transmission lag. Net interest margin for quarter 4 was 3.7%. The spread on loans over the cost of borrowings for the year ended March 31st, 2023 was 2.29%. The spread on the individual loan book was 1.92% and on the non-individual book was 3.62%. Income earned from deployment of surplus funds in cash management schemes of mutual funds and government securities was much lower at rupees 245 crores as compared to rupees 561 crores in the previous year. This was due to average levels invested this year in liquid funds at rupees 4,553 crores as compared to rupees 11,843 crores in the corresponding period of the previous year. There was no profit on sale of investments during the fourth quarter, both in the current year as well as the previous year. For the full year, there was a profit of rupees 184 crores on sale of investments compared to rupees 263 crores in the previous year. Dividend received during the quarter, was rupees 207 crores compared to rupees 128 crores in the corresponding quarter of the previous year. Dividend during the year was received predominantly from our group companies, and during the course of the year, we earned a total of rupees 2,735 crores by way of dividend as compared to 1,511 crores in the previous year. During the quarter ended March 31st, 2023, for investments classified as fair value through profit and loss account, which is FTPL, there is a gain of rupees 273 crores as against rupees 267 crores in the corresponding quarter of the previous year. For the full year, the net gain on fair value changes stood at rupees 362 crores, which is significantly lower when compared to rupees 938 crores in the corresponding period of the previous year. This is entirely due to the volatility in equity markets. Under Indian accounting standards, the stock options granted to employees are measured at the fair value of the option on the date of grant. This fair value is accounted for as employee compensation costs over the vesting period of the options. Accordingly, employee benefit expenses for the year includes an amount of rupees 205 crores towards employee benefit, towards stock option cost. For the year ended March 31st, 2023, the cost-income ratio stood at 9.2%. For the quarter ended March 31st, 2023, the standalone profit before tax was rupees 5,398 crores compared to rupees 4,622 crores in the fourth quarter of the previous year, a growth of 17%. Tax provision for the third quarter amounted to rupees 973 crores compared to rupees 922 crores in the fourth quarter of the previous year. The standalone profit after tax for the fourth quarter stood at rupees 4,426 crores compared to rupees 3,700 crores in the fourth quarter of the previous year, resulting in a growth of 20%. For the year ended March 31st, 2023, the standalone profit before tax was rupees 20,014 crores compared to rupees 17,246 crores in the previous year, a growth of 16%. Tax provision during the year ended March 31st, 2023 stood at rupees 3,775 crores compared to rupees 3,504 crores in the previous year. The standalone profit after tax for the year stood at rupees 16,239 crores compared to rupees 13,742 crores in the previous year, a growth of 18%. Pre-tax return on average assets for the year was 3.0%. Post-tax return on average assets was 2.5%. The basic and diluted EPS on a face value of rupees 2 per share was rupees 89.20 and rupees 88.50 respectively. The consolidated profit before tax for the year stood at rupees 32,131 crores as compared to rupees 28,252 crores in the previous year. After providing rupees 4,431 crores for tax, the consolidated profit after tax for the year stood at rupees 27,700 crores as compared to rupees 24,042 crores, a growth of 15%. The profit attributable to the corporation was rupees 26,161 crores as compared to rupees 22,595 crores in the previous year, a growth of 16%. The Board of Directors, after assessing the capital buffers and liquidity levels, have declared an interim dividend of rupees 44 per share. This is a face value of rupees 2 per share, and this compares to rupees 30 per share in the previous year. The dividend payout ratio is 49.7%. The record date for determining the shareholders entitled to receive the interim dividend for the financial year ended March 31st, 2023 is May 16, 2023. As at March 31st, 2023, the corporation had 4,017 employees. Total assets per employee stood at rupees 175 crores. Net profit per employee was rupees 4 crores. Let me spend a few minutes to give you an update on the merger. As you are aware, on April 4, 2022, the Board of Directors of HDFC Limited and HDFC Bank Limited approved a composite scheme of amalgamation of HDFC with HDFC Bank, subject to regulatory approvals from various authorities, statutory authorities, regulatory authorities, shareholders, creditors, etc. Upon the scheme becoming effective, the subsidiaries associates of the corporation would become subsidiaries associates of HDFC Bank. HDFC Bank will then be 100% owned by public shareholders, and existing shareholders of HDFC will own 41% of HDFC Bank. The final hearing of NCLT was held on February 27, 2023, approving the scheme of amalgamation. You may also be aware that clarifications and requested forbearances have been provided by RBI. We are in the process of obtaining all the residual approvals from the respective regulators in respect of the subsidiary and associate company. We expect the effective date of the merger to be around July 2023 based on the current progress. HDFC's distribution network spans 737 outlets, which include 214 offices of HDFC's wholly owned distribution company, HDFC Sales Limited. HDFC covers additional locations through its outreach programs. We continue to engage with all our stakeholders on ESG. In accordance with the SEBI requirements, the business responsibility and sustainability report for the year will be uploaded on our website shortly. For further information on ESG related queries, you may engage with our investor relations team, Anjali and Conrad. The corporation's corporate social responsibility activities focus primarily on healthcare, education, persons with disabilities, and environmental sustainability. CSR activities were conducted either directly or through the H.D. Parekh Foundation. The CSR spend during the year was rupees 214 crores. The above are some of the highlights of the results for the year ended March 31st, 2023. We may now proceed to question and answer. I would request you to kindly introduce yourself and be brief with your questions, and I and my colleagues who are sitting here will try to respond to your questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to limit their questions up to 2 per participant. If time permits, you may join the queue for any follow-up. We have our first question from the line of Suresh Ganapathy from Macquarie Capital. Please go ahead.
Yeah, Keki, my first question is on the warrants which are expiring on 10th of August. What happens to that? We suppose the merger happens in July.
So the warrants which would have been with the warrant holder who would have got HDFC Limited shares will now get HDFC Bank shares in the same proportion as the merger, which is 1.68.
Okay, fine. So that's clear. Now on the
let me complete that. In other words, if you are entitled to, let's say, 100 shares of HDFC, instead of getting 100 shares of HDFC, you will now get 168 shares of the bank.
Okay, clear. Now, on the LCR thing, so you're saying your LCR is 128% and your government securities holding is 63,000 crores. In other words, 63,000 crores divided by the net cash outflow is equal to 128%. Is that the way we should look at it? I'm just wanting to understand what is the excess cushion that you hold, because once you go into the bank, you need to have an LCR of 100%. So will I calculate that excess 28% as the excess SLR? If I do that, it comes out to be 15,000 crores.
So Suresh, that amount is actually keeps fluctuating because it all depends on the next 30 days outflows. Okay. So as I mentioned to you last time also, depending upon how the liability profile is actually shaping up, the next 30 days outflows will keep fluctuating. So as you are talking today, based on that, and also the way the LCR is computed for NBFCs and the banks are different, because the run rate for some of the liabilities are different for the bank and different for the NBFC. So if you consider all that, if you were to apply this 128 roughly, this is just a rough number, this 128 will probably convert back into something like 70% of the bank, 70-75% LCR for the bank in a banking model actually.
Oh, then the corporation doesn't carry any excess liquidity, right? Because on the contrary, then the bank will have to scale it up on day one as per the RBI requirement.
No, but there are 2 parts. One is you are talking about SLR, CRR, you are talking about LCR.
Yeah, look, the point is, if you guys don't carry any excess liquidity because it goes to 75%, that means there is no excess government securities which is sitting on the HDFC Limited balance sheet which will be counted. What we are arguing here is that there is no cushion being provided by HDFC Limited whatsoever to the bank on the effective date of merger.
But as I mentioned to you, this figure is not going to be constant till the date of merger. Because as the liabilities are getting replaced with longer term liabilities, the LCR will automatically go up and it will result in a higher listing in the banking system also.
Okay. Sorry, I'm just going to push myself to a quick couple of questions because it's important for everyone. Can you tell me, based on your ALM pattern, how much proportion of term loans, deposits, and bond market borrowings will mature in the next 12 months?
So roughly about, if you take, this is a rough number, every month, monthly the maturity, the scheduled maturities of all the various borrowings are somewhere in the range of 10 to 15,000 crores.
Per month. Okay, fine. Okay, so that's the scheduled maturity. Okay. And my final question is the future for HDFC Credila.
So we will engage with RBI and to try and see whether we can get this onboarding of new customers resolved. Once we have some clarity, we will certainly come back to you. But we've already announced that we would look at willing to look at reducing our stake in the company from 100% to 10%, and a variety of people are calling and making bids. So we are still collating all that.
You can do this before July, or you can, it is flexible. It can be done even after.
To my mind, it can be done in the next couple of months because the number of bids we've received a lot of bids. So hopefully by the end of June, we'll be able to arrive at some finality on how to close this. Theoretically, assuming that there is no extension from RBI in terms of onboarding new customers.
Okay, very clear. Thank you so much.
Thank you. We have our next question from the line of Mahrukh Arjania from Nuvama. Please go ahead.
Yeah, hi. What would have been the gross liability mobilization during the fourth quarter?
Fourth quarter, okay.
I think while Rangan is looking for the numbers, can you come to your second question?
Yeah, my second question is that what would be the contractual maturity of these liabilities, right? Because the swap does not.
Yeah. So when you see the current exchange filings we've been doing, you'd have seen that a lot of incremental borrowings that we've been doing in recent times have all been long-term liabilities. We raised 10-year bonds a month ago. We raised 10-year bonds recently. So we are elongating, increasing the tenor of our liabilities. Also, if you look at the deposits, and I mentioned this in the call, that we are reducing the level of corporate deposits and increasing the level of individual deposits, because individual deposits typically have a lower time. Rangan will answer your question.
The last quarter gross mobilization, this is a gross number, not the net. Gross mobilization of liabilities across all products is 85,000 crores.
Okay. And the total maturity of the book will be what now? The contractual maturity. I know that the newer borrowings are at a higher maturity, but any ballpark number?
I mentioned it in the last one. This is ranging from about 10 to 15,000 crore every month.
Okay.
Or on the 10,000 crore
okay.
side.
So that's the repayment in terms of years. The
scheduled maturities of repayment.
Okay.
So when there is a scheduled maturity, for example, you take a deposit. A significant portion, more than 2/3, probably much more than that, 70% plus of our deposits tend to get renewed on maturity. This number, when you ask what is the scheduled maturity, it will be included as part of scheduled maturity, even though the amount will get renewed. So while 10,000 might be the scheduled maturity, in reality, the number turns out to be lower, depending on the quantum of deposits that are maturing in the market.
Got it. And in terms of classification of infra bonds or classification of long-term bonds as infra, that should be easy to come by. Though I do know that it requires RBI approval, but.
Well, this is something we will seek clarity from RBI and come back to you.
Okay, I just have one final question. So it happens in many quarters, but just trying to understand the logic behind it. So how does the income from assignment move? Because sometimes it looks too high.
So what happens is at the beginning of the year, it is based on certain estimates as regards the expenses. By the end of the year, and estimates of prepayments. By the end of the year, you have the exact number, and therefore there would be some adjustment that would happen in the last quarter.
Got it. Thanks a lot. Thank you.
Thank you. We have our next question from the line of Mansi Sajeja from SBI Funds Management. Please go ahead.
So the liabilities that you have raised in last year is amounting to 78,000 crore. And in this current financial year, we have seen another couple of bond issues. So what is from that is, all mainly long term. But on an interest rate sensitivity perspective, what is the, how are you managing the interest rate risk now that they're going to be transferred to a bank? And for all the fundraising approval that you have taken for the current financial year also, how would you do that?
Yeah.
So on the interest rate sensitivity, I think we mentioned it the last time also that if you look at the total liabilities, there are swaps which are done to manage the liabilities from converting from fixed to floating. They are roughly about 2,20,000 crores. And in over and above that, the other liabilities like a bank borrowing and others, which is another about 1 lakh crore, that would be also be more or less linked to the market benchmark, whether it is repo rate or whether it is linked to the T-bills and all that. So if you were to broadly look at the total liabilities of 5.5 lakh crores, about 220 plus another about 1,10,000, so 3,40,000 crores will be liabilities which are sort of linked to the external benchmarks or some sort of banking benchmarks.
So you would have seen in all these quarters that interest rates go up, interest rates go down. You generally see that our spreads remain within a very narrow band because of our ability to hedge these risks.
Okay. So just one last thing. In terms of various exemptions needed from various, debt investors, there is classification of bonds and housing finance, and there is classification of CP as a different category. Any representations again done from your side, or it is depending upon each investor's classification?
Sorry, we are not clear on the question.
So you are classified as a housing finance company, but then all these bonds will be grandfathered in a bank, which may have a different kind of a classification.
So obviously, we have represented to all the respective regulators, and we will obviously hear from them in due course. But my sense is grandfathering is something which we would logically think that they would be able to grant us.
Okay, thank you.
Thank you. We have a next question from the line of Adarsh Parasrampuria from CLSA. Please go ahead.
Hi, Kiki and Rangan.
Sir, you're sounding very low. Can you please use your handset?
Okay, hopefully this is better. Hi, Kiki and Rangan. Question is on your rundown of loans on the corporate side. Are we largely through, or there is still some more to go before the merger?
I would say we are significantly done, very, very significantly done. There might be a little bit more left, but I don't think it will be much.
Okay. And, sir, on your PSL compliant book, right, I just wanted to understand could you quantify by March end where we stand today? What would be the PSL compliant book that would be on our balance sheet?
1,10,000 is around
about 1,10,000 crores.
Okay. And lastly, you did respond in terms of maturity per month, but if you could just broadly indicate some more color on especially the bank loans and bonds, because deposits might, you can renew that. Term loans and bonds, what kind of maturity increase that one would have seen, because we've seen you issue many long-term bonds and probably would have done something similar on the bank loans as well. So what kind of duration increase have you seen through the last 6 months or 12 months?
So you would have seen others that all the borrowings we've been doing through the bond market have all been long-term borrowings. We did a 25,000 crore issue a couple of months ago, 10-year bond. Recently we did a bond issue, again 10-year bonds. It's all largely long-term bonds. And ever since this NCR requirement came in, we have been trying to raise more of long-term funding, because short-term funding brings with it a certain element of cost because of the NCR requirement.
So, others, if you have to look at the current year borrowing, whatever we have done on a gross basis, the NCDs have come for close to almost 100 months, which is almost close to a 10-year type of a borrowing. The bank loans on an average has been about 15 months. But what is happening is, as the bank loans are maturing and all, we are also negotiating it for a longer period. So by the time I think the merger happens, some of the borrowings would have been actually converted into longer term. And similarly, if you look at, we raised an ECB which is close to about 43 months, and then the deposits are close to about 3.5 years.
Got it. Just on the bank loan part, given that it's been more like 15 months in the last 12 months, would the stock be also like a 15-month bank loan, or the efforts would be to really, because this probably is the largest refinancing pressure as you move into the bank. So the bank loan book, right, which is about 1.5 crores, that book, what on a stock basis would be the duration?
So typically, if you have to take the total bank book, they will be on a stock basis as they exist today on 31st March. They would be somewhere at about 10 to 11 months, depending upon the quantum of the amount by various other guys. But what is happening is the maturities and also some of the loans we are already talking to the banks. So they will probably be getting moved to a 3-year type of a duration as we get into in the next few days or in the next 1 month. So
got it, sir.
As we move the stock mostly about 60-70% of the stock will get moved to about a 3-year period.
Because that's got it. This has been helpful. Thanks a lot for this.
Yes, others, just to clarify, the 1,50,000 crores that you mentioned as bank loans, out of that, roughly 1 lakh crores is bank loans. The balance are, it also, that number of 1,50,000 also includes the other term loans, which is ECBs and refinance, which is actually long term.
Bank loan is only about 1 lakh of crores.
Bank loans are only about 1 lakh crores.
Got it. So broadly, the way to understand is this 1 lakh odd crores, which would have been on a stock basis today, having a refinancing in the next 12 months. That's where the efforts will be to renew it and have it for a longer tenure.
Absolutely.
Yeah. Got it, sir. This has been super helpful. Thanks a lot and all the best.
Thank you. We have our next question from the line of Shalini Vasanta from DSP Mutual Fund. Please go ahead.
Sir, hi, this is Vivek Ramakrishnan. My question was on SLR. You'll have to build a SLR book, from what I understand, at the time of the merger, and HDFC Bank has excess SLR. So I just wanted to know how much SLR you have at this point of time and how much you'll need to build up by the time of the merger. That's my only question. Thank you.
So broadly, the SLR, as KK mentioned, is about 64,000 crores. That is the GSEC plus the cash which we have. And from a requirement perspective, on our balance sheet, it is about 1 lakh of crores. So you know what is the excess at the bank level, and also you can compute because the bank is holding a higher because the LCR is about 110%, which automatically translates to close to about 22-23% from an LCR perspective.
Okay, sir. Thank you very much. That was very useful. Thank you.
Thank you. We have our next question from the line of Shri Karthik Velamakanni from Investec. Please go ahead.
Thank you so much. I just wanted to confirm the disclosure around LCR that you mentioned, that the 127 under an HFC translates to a 75% under a bank hood. Is that the right interpretation?
Sorry?
120 translates to 75.
Yeah, it works out around 75-80% in the bank format, because the bank format is different.
And you also indicated some glide path as to how this 80% moves to 100 eventually. Could you please elaborate on that again, please? Thank you.
See, basically what is happening is some of the, as Kiki mentioned, the corporate deposits which are there, the growth on the corporate deposit has been lower. So we have been replacing some of these maturities into longer term. So automatically that changes the color of the LCR. And secondly, some of the deposits where there is the runoff actually higher, we are trying to get consent from some of the higher value depositors to make it 31-day type of a notice type of a product where they will actually give a 31-day notice prior to taking any premature withdrawal. So that basically brings down that basically increases the LCR component.
And sir, lastly, the interest rate swap book that you currently carry, could it be transferred into a bank as is, and what would be the implications from a regulatory perspective because of this particular portfolio?
So our understanding is that we have, the entire swap book will go into the bank. There is no regulatory restriction from there. From an accounting perspective also, it will remain pretty the same. The same hedge accounting which we follow here will continue to be followed at the bank level also. So there is no change as far as either the accounting is concerned or the regulatory position is concerned.
Thank you so much.
Thank you. We have our next question from the line of Pooja Kabra from Sahasrar Capital. Please go ahead. Pooja Kabra, we have unmuted your line. Please ask your question.
Hello.
Yes, we can hear
Yeah, please go.
Yeah. Thank you for the opportunity. I just wanted to ask that what is your attrition rate in the management level and one step down level?
0.
Okay.
0. Management level 0.
Okay. And what is your ESOP working ratio?
I'm sorry, what is your what ratio?
ESOP provision for that?
Provision cost.
So that we mentioned, I think it's some 200 crores or something for the year.
Okay.
I mentioned in the.
The next question is like digitalization improvement idea. Do you have any regarding this?
Digital improvement.
What? And what?
Digitalization. Do you have any digitalization ideas?
Yes, we are continuing to, continue to what we are doing on digitalization, and as we move ahead, and we, as we mentioned earlier, that we got a new LOS and Salesforce, and we are trying to have the whole journey different. So, this is an ongoing process. It takes, a few months or maybe a year or so, but as we go ahead, things are getting added on more and more. So I think in another 6 months, the whole process most probably will be through. So it's going on, and it's going on very well.
Just 2 things to add. One is that the employee benefit cost, we talked about the ESOP cost. It is 205 crores for the whole year compared to 390 crores in the previous year. And 94% of the new loans we've done have been digitally onboarded.
Thank you so much, sir. Thank you.
Thank you. We have our next question from the line of Saurabh Kumar from JP Morgan. Please go ahead.
So I just wanted to confirm 3 numbers. So one is for the NDTL calculation, the SLR number will be 4.7 lakh crores and for CRR 3.6 lakh crores. Is that assumption right?
You're talking from HDFC Limited perspective, right?
Yes.
I'll just come back to you on that.
Okay. And also the, adjusted net bank for PSL should be about 5 lakh odd crores based on the numbers you've given. I just wanted to confirm these.
Yeah.
Thank you, sir.
Thank you. We have our next question from the line of Rakesh Kumar from B&K Securities. Please go ahead.
Yeah, hi. Thank you. So, just from this, longer term, borrowing that we are doing, so is it to do with, maintenance of NSFR for banking, for the HDFC Bank post-merger, or is it, it is for short-term liquidity?
No, it's not a short-term liquidity thing, but even if you look at the interest rate today, it is pretty flat, whether you borrow 1 year or whether you borrow 10 years. And the assets are typically longer term. So you need to fund these assets with longer term liabilities. And as Keki mentioned that when you borrow short term, then it also hits into your LCR.
And the total SLR, we gave the number of, can you repeat the number, sir, please?
Our SLR, we said, is about 64,000 crores. We are holding about 64,000 crores of common security.
So even in the case of HDFC Bank, though it has the excess liquidity, but the LCR is just around 10% more than what is the mandatory requirement. So like how would it add up, like post merger?
So basically, these two numbers are interdependent. Actually, the LCR and the SLR number. So when you convert that 110% LCR into a SLR number, the SLR actually moves up from 18 to, my guess is about 22-23%. So to that extent, from an SLR perspective, there will be a surplus which will be coming in there.
Okay. Thank you, sir.
Thank you. We have our next question from the line of Anand Dama from Emkay Global. Please go ahead.
So thank you for the opportunity. Sir, this quarter we have seen deposit book actually running down quarter on quarter. Is it more strategic or basically primarily from the customer side?
So I mentioned that to you. I mentioned that when I originally spoke, that we have not been encouraging or not been looking out too much for corporate deposits, because generally these tend to be of a shorter term, and as I've been saying repeatedly on the call, when we get short-term money, there is a higher cost because of the LCR requirement. So we prefer to take the individual deposits which have a longer tenor, and the proportion of individual deposits as a percentage of the total deposit has gone up quite sharply during the year. Individual deposits has constituted about 16% of our incremental funding during the year. So corporate deposits have gone down, individual deposits has gone up quite sharply. The proportion of individual deposits to total deposits has also correspondingly increased.
And so what will be the average cost of this deposit book that we are carrying on?
I mean, I'm giving a spread. The spread is 2.29%. Now, deposits it varies from time to time depending upon how much deposits you're carrying. Broadly, the spread is the same in whichever segment you look at.
Okay. And sir, lastly on the wholesale book, so I think HDFC Bank said that basically we are going to seek the permission from the RBI in terms of the line funding book.
I'm sorry, sir. Can you use your handset, please?
I can't hear you. We can't hear you.
Yeah, sure. Sir, on the wholesale book that we carry on our book, so within which basically we have sort of this construction developer financing book. So what's going to be the status of that once the merger happens?
Of course, it continues in the bank. Of course, it continues into the bank.
Okay.
And in fact, as we do more construction finance loans, see, let me explain this. I explained this in the past several times. That when you do a corporate loan or you do a lease rental discounting loan, your entire loan gets disbursed in one go. But when you do a construction finance loan, the disbursement is linked to the stage of construction. So the developer first puts in his equity, and then after that you start disbursing as he constructs. So construction finance disbursements come over a longer time frame. So there is a reasonably healthy pipeline in terms of construction finance proposals. It's just that, as we've been saying quarter after quarter, it takes a while before these disbursements happen. So there would be a fair amount of disbursements that have happened this quarter also, and there will be more as time goes by. And all these construction finance loans will move into the bank because these are backup plans.
But can you just give out what basically is a land funding book? Because HDFC Bank in the call said that there is a land funding book basically where they will need to seek the RBI permission.
Land funding book?
I mean, yeah, they said something about that. So there I think they said that you will have to seek permission from the RBI to carry on to HDFC Bank's book.
Some of the dispensation on the non-individual book, they have.
So those words, whatever is there is not material at all. You see, whenever a merger happens, there is always a grandfathering of assets and liabilities which is sought. So in the grandfathering, there would be a whole lot of items which should have got included, which could have included some element of what you are talking, but that quantum would be insignificant.
Okay, sure, sir. Thanks.
Thank you. We have our next question from the line of MB Mahesh from Kotak Securities. Please go ahead.
Hey, hi, good afternoon. Just two questions from my side.
One is if you look at the disbursement number, there seems to be over a period of time a little bit of a slowdown in the last couple of quarters. If you could just kind of highlight how is the situation on the ground?
The situation on the ground continues to be strong. I don't know whether you were there on the call right through or not, but I mentioned at the very beginning that March 2023 saw the highest amount of individual loan disbursements we have done in any month in HDFC's history. So we said that the momentum we would expect would continue, and I would hope that the year ended March 2024 should see almost similar kind of a growth, almost.
Okay. And so far you would say that the impact of interest rates has been extremely negligible on the ground?
It is apparent, no? If the disbursements are strong and March is the strongest month, it is apparent. So you must understand that a housing loan is a long-term loan. It's not a 1-year loan or a 2-year loan. So when you are taking a long-term loan on a floating rate basis, interest rates will go up and interest rates will come down. But the reality of the matter is that when you are taking, and all these loans are floating rate loans. So if rates are high today, when they come down, you'll get the benefit of lower rates. If they were low today, you'll get the benefit of higher rates. So it has more a sentimental impact, if any, but not really an economic impact. On the other hand, shorter-term loans probably would have a bigger impact because it's unlikely that in the very short term, interest rates would come down.
So just to clarify here, is that number right that we have that the disbursements in the fourth quarter would be about 52,500 crores? Is that number right? Because we don't get the absolute numbers, we just get the percentage. So we're back
50,000 crores. Yeah, it's a little under 50,000 crores.
So that would translate to about a 10% growth on a YOY basis on disbursements for the fourth quarter. Is that number right?
See, you have to look at it for the whole year because we have each quarter has had its own challenges. But the fact is, if you look, as KK mentioned, the March, which was the last month of the year, was the highest ever. So, now if you go back to October and November, was a relative lower number because of the holiday season between Diwali and Dasra and such, and school holidays. So I would really look at it over a longer period. And if you look at a longer period, I think the absolute disbursement growth between 23 and 22 has been 16%, which I think is very healthy, given the interest rate movements that have taken place during the year.
Sure. The second question is that how have borrowers managed the increase in interest rates in the sense that is there an outside limit under which a loan tenor can be increased?
Of course, there is an outside limit. Every case is evaluated on a case-to-case basis. It is not that automatically when rates go up, the term goes up. In a normal case, the term does go up. However, the system is geared to identify cases where there is some degree of concern. In those cases, the customer is explicitly contacted, and then either the term is lowered by him making a part prepayment or the installment amount is increased.
Would you be able to quantify that as well, or do you think it's going to be difficult?
Quantify what?
How have you addressed it in the sense that how much of these loans may have seen tenor extensions versus EMI increases?
In the normal course, if you understand the business, you would know that when rates go up, we increase the tenor of the loan. When rates come down, we reduce the tenor of the loan. Housing loans get prepaid. Roughly about 10-11% of the loans get prepaid ahead of schedule every single year. This is a normal trend which happens. So when you look at a 3-year, 5-year period, it all sort of neutralizes. In the short term, you might find that the term has gone up compared to what the original term was, but it will not happen to in a situation where the term goes up so much that it causes any kind of a concern or discomfort. In such cases, the system identifies such individuals, and then on a case-to-case basis, the individual is contacted, and either the installment is increased or the part of the loan is the customer is requested to prepay part of it. So it's worked several times over the years, and frankly, it has never resulted in any kind of impact on recovery. Historically, and this is probably the third or fourth time probably that we've seen this thing happen.
Sure. Perfect. Thanks for this.
Thank you. We have our next question from the line of Jay Mundra from ICICI Securities. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity. If you
I
can
cannot hear
share.
you clearly. Please use your handset.
Yeah, hi. Good afternoon. Sir, if you can share the indicative yield on your corporate LRD and construction finance book for fourth quarter.
Look, I told you that the spread on non-individual loans is 3.62%. The spread on individual loans is 1.92%, and the overall spread that we earned was 2.29%.
Right. And sure. And the cost of deposit or the cost of funds that you use, is that similar for both these segments, or that can be
broadly similar? Broadly similar, but you can't pinpoint these things because you raise funds right through the quarter, and during the course of the quarter, interest rate volatility is always there. So there may be times when there is 20 basis points higher, and there may be times when it's 20 basis points lower. So what we have to do is we have to manage our spreads carefully, and that's what we've been doing all these years.
Sure. And during the call, I think it was mentioned that the absolute amount which would be reckoned for SLR and CRR calculation, if you have that number handy, I think it was told that you will come back.
No, I think we mentioned that the total amount of government securities we carry is 64,000 crores.
No, sir, I was asking for NDTL. The total NDTL as of 23rd, as of FY23.
Okay, I think Rangan will just get that.
Hey, can you call separately? We can give the number.
Sure, sir. Yeah, thank you.
Yeah.
Okay.
Mr. Mundra, are you done for now?
Yeah, thank you. Yeah, done.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to the management for closing comments. Over to you.
Well, I'd just like to thank everyone for all your help and support all these years. And if you have any further questions on the results or on the process of merger, then please get in touch with Conrad, Anjali, Rangan, me, whoever you like. Thank you, everyone.